Hi, Peter Schiff. How are you today? It's so nice to have you here with us. You've got an incredible following in the world of finance globally and domestically, and so we're glad you're with us.
Oh,
Um,
my following is on the fringes, at least as far as I know.
well, you have a pretty big following from what I see out there. Anyway, as far as the fringes go, we're living on the fringe financially. We have crazy fiscal and monetary policy in place. We're living in this era of liquidity where we've got this tremendous liquidity rally and we're at the debt maximums across the board on different areas. How long can this rally continue, Peter?
Well, I don't know. I mean, it's already, I think, living on borrowed time, literally. And, it's not really just liquidity, it's inflation. And that is the best way to describe what is happening. You have massive inflation being generated by global central banks. And that inflation is, finding its way into stock prices and bond prices and real estate prices and to a limited degree, consumer prices. I mean, consumer prices are rising, they're not falling. And I think they're rising faster than the government admits with their measures, their official indexes. But I think that a lot of the inflation is showing up predominantly in these financial assets. And so when that happens, people are not concerned about inflation, but inflation is still doing a lot of damage to the economy. And ultimately, no matter how inflation enters the economy, it ends up in consumer goods. So that's where it's all going. So right now, it may be temporarily hanging out in the stock market and people feel richer, but when it ends up in the supermarket, they're going to feel a lot poorer.
Those are all really good points. But we've had a heck of a melt up here under the Trump administration. As you were watching, the theme of our show was the tax cuts and what Trump has done from deregulatory perspective and the China trade deal. How has that benefited the economy, and what do you see happening in the future?
Well, I don't think anything that Trump has done has really benefited the economy. I don't think we've done anything to, deal with the long-term problems, the structural imbalances that have been plaguing the economy. I think all we've done is inflate a big bubble. But we did the same thing under Obama. We did the same thing under Bush. We did the same thing under Clinton. So this is business as usual at the Trump White House. We did get some stimulus, which we've had before, where you cut taxes and increase government spending, and now you get a temporary boost as we spend all that borrowed money. But when the high wears off, you find yourself in a very deep hole, and that's exactly where we're headed. I think where we're going now is going to be into a much worse economic environment than what we had in the Great Recession in 2008. The payback from this high is going to be much bigger than the payback from the previous time the Fed did this.
I couldn't agree with you more. We have this new addiction of liquidity and debt. And if that starts to curtail or fall off or get withdrawn or de-escalate, what's going to happen is we're going to feel the economic effects, and asset prices will drop, the economy will slow down, and then we've got the political risk quotient here that's going to happen. If we have a downturn, we'll probably see the country go socialistic, and that has its own problems.
And it's not really about the economy slowing down. The economy never really sped up. I mean, it's about the bubble deflating. I mean, the bubble certainly got bigger. There's no disputing that fact. But if you look at what's going on in the U.S. economy, we have record budget deficits. Our budget deficits are soaring. That is not consistent with a strong economy. If you have a strong economy, the government benefits from that strength because it collects more in tax revenue and it doesn't have to spend as much on social safety nets. So normally when the economy is booming, the deficits are shrinking. Instead, our deficits are going the other way. Also, look at corporate profits last year. They actually declined. How can we have a boom, but businesses are making less money? So there is no real boom. It's just a fantasy that's being created by the Fed, but being perpetuated by Donald Trump, who wants to take credit for an economic boom that only exists in his imagination.
Interesting comments, Peter. Well, listen, we've got to take a break. We'll be right back. So, Peter, you're the president of Euro-Pacific Capital. So Euro-Pacific Capital, do you guys focus on Asia or do you focus on global trends or domestic trends? What is your main focus at Euro-Pacific Capital?
Yeah, well, first of all, right now I'm basically the chief market strategist and economist. I used to own the business, but no longer. I now work for my asset management company out here in Puerto Rico. But we do manage accounts through Euro Pacific, which is now a division of Alliance Global Partners. And we focus on international markets. We focus on non-dollar investments, equities, and to a lesser extent, bonds. I think the most important thing that U.S. investors can do is abandon ship before it sinks. And it's not just getting out of the U.S. stocks and the bond market, but getting out of the dollar. That is the biggest problem. That's likely to see the biggest loss. So while I think U.S. stocks are going to go down, and I think investors will lose money over the next 3 to 5 years in U.S. stocks, the money they don't lose is even going to lose more value. So you got to get out of the dollar. But we also focus on commodities, on gold. I help people buy physical gold as well as invest in the mining stocks. I think the home runs, the 10 baggers or more of the next 5 to 10 years are going to be found in the mining sector. I think the price of gold is going to surprise a lot of people by just how high it goes. I mean, the last time in 2011, we peaked out at 1900. Right now, we're just over 1550. We're up about 50% over the past 4 years. But I think we're going into completely uncharted territory in the price of gold. And I think the mining stocks are not priced for this at all. I think the mining stocks are priced for the gold price to go down. They're ignoring the fact that gold prices are rising. And there's a lot of skepticism there. There's nothing but optimism about U.S. stocks. People are, chasing the market to new highs and bidding up prices. But they're not doing that with the mining stocks. I think they will eventually. I think there's going to be a speculative phase years from now in that sector, but we're not there yet. Right now, smart money are accumulating these stocks, and that's what we're helping our clients do through separately managed accounts and through a mutual fund that we manage, the Euro Pacific Gold Fund.
So yeah, you stole the next answer to my question. For the average investor, average pre-retiree, retiree today, because we could be looking at those inflationary components in commodities in the near future, what percentage of someone's portfolio would you advocate towards gold?
Well, physical gold versus mining stocks, very different types of investments. Mining stocks are speculative, and you're betting on the fortunes of a company, and you're subject to the vagaries of costs and earnings and political risk, depending on where their mines are located. So that is part of a speculative portfolio. But I think every investor, particularly conservative investors, need to have at least 5 to 10% of their portfolio in physical gold, maybe even more, given how overvalued U.S. stocks and the U.S. dollar is, and especially if you're nearing retirement. I mean, that is the key. Inflation is going to wipe out the retirement for most Americans. I think most Americans who are nearing retirement age will never retire. And I think most Americans who are already retired are going to be re-entering the workforce, because I think their money is going to end up retiring, not them. And so you need to be cognizant of this, especially if Trump is not reelected and we get a President Bernie Sanders and we get a Congress that is sympathetic to the way he wants to remake America as an even more socialist economy. And he wants to introduce all sorts of government provided benefits, free education, free health care, government jobs. All this stuff that they want to do is going to cost a fortune. And yes, they want to raise taxes on businesses and the rich.
Peter, let me interrupt for a minute. We'll come back to that point in a minute. Let me interrupt. So yeah, everything free is not good for the economy. So we'll be right back with more right after this break. Now let's welcome back Peter Schiff, Chief Economist and Global Strategist of Euro Pacific Capital. Peter, thank you for sticking around. It's so awesome to talk to you. I've been an admirer of yours for a long time, and I've seen you on all the major networks, and you've got quite a following in social media, even though you're humble about it to a certain degree. Interest rates. There's been a lot of talk about interest rates. I hear a lot of the pundits on the major networks talk about rates going up in the fall. And I don't see how it's physically possible for interest rates ever to really go up ever again because there's just too much debt. We have too much debt. In December of 2018, the debt service with those 3 rate increases that year would have increased from $200 billion as an average to $800 billion just here domestically. And we simply don't have the money to spend on debt service, and neither does the globe. So I think we're in a permanent low interest rate environment. Tell me what your thoughts are on that.
Well, that's not true. I mean, it's kind of like saying, I don't have an umbrella, so it's never going to rain again. It's going to rain, you're just going to get wet. And so their interest rates are going to go up eventually. Now, the government, the Federal Reserve, is doing everything it can. That's why it's back to QE in the repo markets. It doesn't want to admit that that's what it's doing, but it is. But it's doing that to artificially suppress interest rates. Why does it want to do that? Because it knows if it allows interest rates to rise to the level that the market wants them, that we're too broke to afford it. And so we would have another financial crisis. But it wouldn't just be banks failing. The U.S. government would default on its obligations as well. And this would be a much bigger crisis than '08. And so in order to postpone the day of reckoning, the Fed is holding interest rates artificially low. But by doing that, they are worsening the debt bubble. They are making the underlying structure of the U.S. economy much weaker. So we're digging ourselves into a bigger hole, and it means that when the Fed eventually loses control of interest rates, they're going to rise that much more, and the pain is going to be that much greater. And of course, the real risk is that in trying to keep interest rates from rising, the dollar ends up crashing. Because the only way they can keep rates from going up is to keep printing money to buy bonds. But when they do that, they risk collapsing the dollar, and that creates a currency crisis, which is even worse for the U.S. economy. So just because we can't afford to have a bad thing happen doesn't mean that now that bad thing is not going to happen. It just means it's going to be much worse. And what I was saying before about the government trying to provide all this free stuff, it's not free, especially when it comes from the government. They're going to pay for it by printing money, creating inflation, and we're going to wipe out a generation of retirees who have put their trust in the future purchasing power of the dollar, and the dollar is going to be destroyed because they're going to have to run them off the printing presses to provide all these goodies that have been promised. And so to avoid that or protect your savings and your retirement from this massive inflation tax that's going to decimate everybody, you got to get out of U.S. dollars now. You got to avoid that tax by avoiding U.S. markets, avoiding U.S. dollars, own foreign assets, own foreign stocks, own precious metals, own mining companies, because I think that's the only way to secure retirement in America.
Well, those are all good points, Peter. There are different ways to secure retirement in America, but I have to disagree with you on the fact that I think we're going to be stuck in a long-term low interest rate environment simply because we won't be able to service the debt that we've created as the debt monster has expanded into a giant hurricane of potential problems, and it keeps getting bigger and bigger and bigger.
How do you do that? I mean, it's not like a central bank can just decide we're always going to have low interest rates. I mean, because there's a consequence to that, right? Because they have to keep printing money to do that. And so you can't do that indefinitely. You can't. It's like saying, gas is expensive, so we're just going to put a price control and make gas cheaper, or we're going to make bread cheaper. I mean, the government just can't decide that a product should be less expensive.
Well, the government is not the Fed, Peter. The Fed is independent of the government.
But
they're
the
completely
Fed
separate.
is acting as if it were part of the government. I agree that the Fed is supposed to be independent, but it clearly is not. It is clearly acting as if it was a branch of the government, and it is pursuing monetary policy based on a political expedience. If the Fed was really independent, it never would have done QE at all. That's just monetizing government debt. It would have allowed interest rates to rise and forced the government to make difficult political choices, cut government spending, reduce entitlements, raise taxes, whatever. But the Federal Reserve spared elected officials having to deal with that by just giving them a free out, by just printing money. But this has created a much more vulnerable economy, and it has set the stage for a much worse crisis than '08. Because remember, the only reason we had a financial crisis.
Well, Peter, I agree with you. I agree with you on the crisis. I agree with you on the potential of a much larger crisis. But listen, that's all the time we have today. Thank you for the spirited debate. It was great to have you. Thanks for joining us, Peter.